This conference will now be recorded.
Oh, there we go. It's recording. Um, we're looking at three historic data signals in terms of the housing market. One is the NAHB Wells Fargo HMI, which is our monthly builder confidence measure, is at an all-time high now. It's a 0 to 100 scale. It's currently stands at a level of 90, which is the highest it's ever been since 1985. It's a real sign of the demand that builders have in front of them, particularly on the single-family construction side. A second historic data signal, the typical price of a resale single-family home, so the median price of a resale right now is real close to the typical price of a newly built home. And that has rarely happened. Typically newly built homes, they're going to be about $20,000 more expensive than your typical resale, at least on a national basis. And what's happened is that you've seen this real acceleration in existing home prices due to a lack of inventory. So that's another reason behind some of that growth in builder confidence. The other factor, a third historic data signal, is we've got the largest ever gap between new home sales and actual production of for sale housing. So there's a lot of backlog in terms of what builders are facing right now. And that can have two impacts. One, it could mean some slowing of new home sales as we go forward, because builders are not going to sign or enter into contracts of construction that they can't complete in a timely manner. But then two, we also will expect some acceleration in home building to reduce that backlog and build out essentially some of those sales that have been undertaken. On the supply side, we do have some very significant supply chain issues. Lumber, particularly lumber pricing, was the big one in 2020. That has stabilized, not necessarily at great levels, but it seems like it's gotten better. But if you talk to builders, you talk to remodelers, they will all say it's taking longer for just about every kind of building material to get in the work site. So that is increasing costs, it's extending construction times, and it's one of those limiting factors in terms of how much actual construction growth we can see for the home building sector. But overall, demand is strong, due to something we call the suburban shift. I'm going to walk you through some maps that will detail that impact. The work from home trend, this is something we were talking about before we started this presentation. It's not going to be permanent. That most people are going to end up going back to the office eventually, but we think that the experience of work from home is going to lead to a higher number of people who are working from home a few days a week. And that's generally a good news item for the residential real estate market because it means people are using their homes for more purposes. The most important thing, though, driving the demand side right now is those historically low interest rates. And I think thanks to the Federal Reserve, and the Federal Reserve is a group that we engage at NAHB from an advocacy perspective almost constantly. But thanks to the Federal Reserve, we do think we're going to have ongoing low interest rates for some time to come. And demographics are really positive for home buying. They were positive before we entered into the virus crisis of 2020. And in part, that's really due to the millennials. The leading edge of the millennials are now turning age 40. So they're really getting to their home buying years, and we have a deficit of single family homes. So there's a lot of growth in home building that's going to take place as we move forward. So let's start with the overall macro outlook. This is our measure of GDP growth. The second quarter of 2020 was the worst quarter the U.S. economy had experienced since World War II. You can see that in this slide. That's that blue column that's down a lot. The growth rate for the second quarter was negative 32%. Again, that was the fastest decline we had in decades. But then we had a very quick rebound, the third quarter up about 30%. Didn't completely offset the loss, so we're still down for the year. We think for 2020 that the outlook looks like about a negative 3.6% decline in GDP. But this is the V-shaped recovery that people were talking about. And I will note as a footnote, there are some economists out there that are talking about a K-shaped recovery. This is the idea that some people are better off, that's the top part of the K, and then some people are worse off. typically when we talk about letter-shaped economies, we're talking about these aggregate measures. And if you look at those two blue bars, the one that's really down and the one that's really up, that's about as V-shaped as you can get. I get what people are saying with the K-shaped recovery. I think it's partly a political argument. We can kind of discuss the fact that there are parts of the economy that need help, that there are parts of the economy where unemployment is particularly concentrated, that the travel and tourism sectors, for example, have a lot of pain. But it's been amazing the degree to which the resiliency of the economy, with help from the Federal Reserve, with help from some of the fiscal policy issues like PPP, that have really stabilized the economy. And it's a shame. I mean, if you think about the shape of the U.S. economy with a 3.5% unemployment rate before we came in, we had just a once in a lifetime labor market. So the fundamental positives of the U.S. economy have helped in this recovery in terms of the resiliency of the growth. Now, going forward, in our forecast, we've got 2021 and 2022 just a little bit below 3% growth rates. We have an acceleration in growth during the second half of 2021 after the mass deployment of a vaccine. And our forecast assumes that about 75% of Americans will be vaccinated by the time the school year starts in 2021, so September or October. And that's really going to help reopen the economy. We think it will take the pressure off local government officials from looking at economically destructive policies like lockdowns. And by the way, I think over the next 2 to 3 years, we're going to have a lot of debate over whether those policies were effective. There were probably a lot of lower hanging fruit, lower cost items that we could have done. But nonetheless, that's a debate for the future. But we think the economy is going to accelerate as we go into 2021, 2022. In terms of risk factors, I think the big risk, particularly coming out of the election, is not the typical things we worry about like tax cuts. It's going to be regulatory policy, particularly on the environmental side and the labor side. So I'm a little more conservative in terms of the economic outlook than some forecasters. For example, Goldman Sachs is really bullish about the next couple of years. I think there could be some policy hiccups that'll slow growth, but overall, we see growth moving forward. And I've been using this data as an analogy in terms of what the economy's gone through. This is just, basically looking at restaurants in red, and it looks like somebody's not on mute, so I'd probably ask to go on mute. The red line is restaurant sales. The blue line is grocery store sales. What you see is in 2015, these actually invert. And again, I think somebody's still on, got a little bit of background noise. Okay, I think it went away. So you can see in 2015, restaurant sales actually get ahead of grocery store sales. And then look what happens when we get into 2020. The grocery store sales spike. This is back in March and April when there was a lot of panic buying with grocery stores. And then restaurant sales fall roughly in half. And then the economy begins to gradually reopen. You can see grocery store sales go down. Restaurant sales begin to increase with the help of takeout, some limited reopenings. But there's a permanent effect left, which is that grocery store sales remain higher than restaurant sales, which is not the case in the prior 5 years. I think this is a pretty good analogy of what the economy's gone through. A really quick disruption, some temporary change that's going to roll back, and then some persistent change that will last beyond this particular crisis. And you can see those temporary effects, the big changes, as well as some of the healing effects that occurred with respect to grocery store sales and restaurant sales. And frankly, everything else that we're going to go through in terms of the impacts on the housing market from the virus crisis involve those kinds of components. So I'm using that as an analogy. And you can see this, by the way, writ large in terms of overall services in terms of the US economy and the goods economy. So you can see a lot of stability in these two measures, the red and the blue on this slide. And then we enter 2020. The service economy experiences a big drop, a little bit of a recovery, then it slows down. The goods economy experiences a drop. And then during the recovery, the goods economy actually grows. And this is part of the thing that's driving the housing market. We're seeing a substitution effect in terms of the U.S. economy, where we're consuming fewer services, particularly travel and tourism, and more goods. So more goods being delivered to people's homes. And so again, you can see the temporary effect, the big declines, the persistent effects, these substitution effects. And this is one of the things that's benefiting the overall housing market. I also included the structures measure in terms of US GDP. You can see it's actually tracking down. This data comes out with a little bit of a greater lag in terms of what we like to see. But the reason for the decline here, not housing, but rather the overall real estate market, which is seeing declines in things like commercial office construction, hotel construction, student housing construction's down about 60%. So housing would have kept that basically from going down even further. In terms of the overall labor market, good news, bad news. The overall unemployment rate right now is about 6.7%. There's some reasons to believe it's a little bit higher than that because of some technical data issues. But the good news is that, one, we never really reached the 20 to 25% unemployment rate that people feared. That's great. And the other bit of good news is that the rate has come down a lot from its peak unemployment rate during the year, which was about 16% on a monthly basis. So we've got the unemployment rate coming down. We do think the improvement in the unemployment rate is going to be slower now than what we saw, say, in the middle of 2020. So you can see that red line at the very end. Yes, it continues to go down. It's headed to about a 5% unemployment rate by the end of 2022, but the improvement going forward is going to be a little bit slower. So that's the good news, bad news. The other factor to keep in mind is that duration matters in terms of spells of unemployment. And so one of the things we're really focused on from a housing demand perspective is what's the number of people, the overall count of people who have been unemployed for 6 months or more. Right now, it's about a third of the overall unemployment pool. So we are concerned about that. And the reason why, in terms of 6 months or more of unemployment, when people are experience that length of unemployment, they do experience changes for things like rental demand and housing demand, buying a car, sending their kids to college. So that's obviously going to be a big policy issue for the Biden administration as we move into 2021. The other factor, and this doesn't get as much attention as it really deserves, the damage in the labor market is not just to the unemployment rate, but the labor force participation rate. So the labor force participation rate measures the number of people who have a job or who are looking for a job. You can see right before we went into the downturn, it was about 63%. In fact, it had actually been improving slowly over the last 5 years. It suffered a lot in the Great Recession and roughly the next 8 years, where you had the labor force participation rate going down. And then we had that great labor market I mentioned before. We had an unemployment rate of 3.5%. It was bringing people into the labor market who had previously dropped out and weren't looking for work. That's good for economics. It's good for. So the 63% unemployment rate is where we started in 2020, and then it dropped down to 60%.
Sharon and Andrea's office, because they said they could go ahead and install these, look at the data line or anything, but they set them in unpack
trying to find out where this noise is coming from, and I've been muting people when I see it pop up. Everybody, please keep yourself muted if you don't know.
I can't bring it to you. Okay.
It's
I
like
can come
a
up in a minute.
phone
What about
call.
your, do you want them to unpack your sets up there where your HV is? Or?
I can do that.
All right. I can do that. Or do we want them just to leave them?
Okay, 1 second, Robert. Okay, Robert, can we hear you now?
All right. Thank you very much, Lance. Magic from Lance there. So we were at a 63% on labor force participation rate, and then it's dropped down to a 60% rate. So it's not just that the unemployment rate is higher, but we've actually got millions of people who have dropped out of the labor market. It has improved. We're up to about a 61% rate. We need to get back to that 62 to 63% range. And by the way, one of the ways that we could do that make sure the schools are open. And this is something I don't want to get too much into the virus policy, but I think that the evidence is that school-age children do not spread the virus very much. And when you shut down the schools, you have a big impact on the labor force because, just imagine your typical family with 2 spouses. If the kids are home, even if they're studying online, there's got to be a parent there. And the result is we've seen millions of American women in particular leave the labor force. So the school policy, virus policy, all these factors get into the labor market. And so getting the labor force participation rate higher is going to be one of the factors that's going to help those sectors that are trying to hire people, because we do have this unusual situation where the unemployment rate's elevated, but you have sectors, including construction, that report labor shortages. And then the connection between those two is the decline and the weakness in the labor force participation rate. All right, so moving from labor to other parts of the macro outlook, interest rates really have been driving the overall housing demand surge that we saw in 2020. The red line is the 30-year fixed rate mortgage. You can see it peaked near the end of 2018, real close to a 5% 30-year fixed rate mortgage. For anyone that bought a home in the 90s, let alone the 80s and the 70s, a 5% mortgage interest rate doesn't sound that high, sounds pretty good. Actually, for today's market, that was actually relatively high. So we had a little bit of a stalling in the housing market when the 30-year fixed rate mortgage got to 4.9%. And then, of course, in 2020, those rates have come down to historically low levels. Looking forward in terms of interest rates, I do think interest rates are going to be the primary driver of whether the current momentum that we see in housing and home building continues. So the bad news is that we do think interest rates are going to go up. Now, that's actually a function of good news. Interest rates are going to go higher because of the fact that the overall economy is going to do better. And when GDP growth goes up, interest rates go up because there's higher demand for capital, and that pushes interest rates up. So you can see in our forecast, the blue line and the red line, the blue line is increasing. So the 10-year treasury, we do expect to go up. It's currently right around 0.9%. I do think for much of 2021, it's going to be 1% or higher. And that's going to push the red line up a little bit. That's the 30-year fixed rate mortgage. It's still going to be well below 4% for the next couple of years. So that's overall good for housing demand, but it is going to creep up higher, particularly as we get deployment of the vaccine. So we're going to be in a kind of a weird situation with interest rates where good news, things like the vaccine and opening the economy, is going to produce bad news in terms of higher interest rates. And that is going to be a limiting factor on the demand side for the amount of home buying that takes place. So I'm a little more conservative in terms of our housing forecast that we'll get to later in this deck. And part of that is related to interest rates. Our research has shown that buyers are very, very sensitive to changes in interest rates. As interest rates went down in 2020, it caused a surge in housing demand. And so I am concerned that as interest rates creep up, we will see a pullback in housing demand because of those higher interest rates. And then in terms of the fundamentals of housing demand, population growth is clearly key. The top line on that table is the U.S. population growth. We went from 2019 to about a 0.8% growth rate for the nation as a whole to 0.5 in 2019. So U.S. population growth has been slowing. Some of that is a slowdown in immigration. And frankly, a lot of it was a slowdown in birth rates that occurred after the Great Recession itself. You can see the regional factors. The primary drivers of population growth have occurred in the West, and really that's the mountain states, much less so than, say, the Pacific areas of like California, Oregon, Washington. And then, of course, the South, with states like Texas, the Carolinas, Georgia, and Florida as having really strong population growth rates. Now, we don't do a forecast of this, but I will tell you that I'm originally from Ohio. I kind of have Midwestern roots, and the Midwest has seen declining population growth rates. In fact, in a lot of markets, it's been relatively flat. I think there's some potential for growth in the Midwest in terms of population growth, and part of that is that suburban shift. that home buyers and businesses are looking to, in some cases, move to lower density, lower cost markets. And we could see a little bit of a pop in terms of population growth for places like Columbus, Ohio, Indianapolis, Kansas City, places that have really hot housing markets right now because they have better housing affordability conditions. So we're going to be watching that going forward. Now, every economist has some version of this slide. We kind of have to do it when we're thinking about the demand side of the market. Basically, the way you read this, the vertical axis is a count of people, the horizontal axis is age, and I've divided the blue line that goes through, which is the population profile of the United States, into various generational boxes. So in the middle, you have my GenX group. We're the smallest generational group. You got the baby boomers, which were the largest generational group. And then the millennials, the leading edge of the millennials, right around age 40. They're the largest generational group in US history. Now, the majority of new construction home buyers are between age 35 and 55. So as the millennials age to the right on this particular slide, the demand for single family housing is going to go up. You've got a small generational group in terms of Gen X being replaced by a larger generational group in the millennials. And that's why we talk about the millennials constantly. And I'll apologize if you're a millennial. As a Gen Xer, I'm sick of talking about them, but they're just so important in terms of housing demand. You can see why there in terms of that hill right around age 30. There's just a large number of them. Now, if you're a gloom and doom type person, or if you're looking at, okay, what can the demographics tell us about maybe future weakness in housing demand? Let's look at Gen Z to the left, and then Gen Alpha, which is the next generational group after Gen Z since we ran out of English letters. You can see that those two generational groups are more like Gen X. They're smaller, and particularly Gen Alpha. So about 10 or 15 years from now, we will have a weakness, particularly in apartment markets, because those generational groups are smaller. But for the next 5 to 10 years, housing demand should be relatively strong because of the millennials. And in fact, kind of going back to the theme of the economy was really strong when we entered 2020. If we look at the first quarter 2020 data, which is the last column on this slide, we have the strongest growth in owner-occupied housing since the Great Recession. So the blue columns are the year-over-year gains for homeowners, and the red columns are the year-over-year gains for renters. What you can see on the slide is from 2010 to 2016, all the growth was really in the red. It was a rental-driven recovery after the Great Recession, a lot of growth for multifamily. Single family kind of lagged, and you can kind of see that the blue columns weren't doing very much. If anything, they were down more than they were up. And then right around 2016, the momentum really shifts. The red columns lose their momentum and the blue begins to take off. Well, what happened in 2016? Well, the millennials began hitting their early and mid 30s. And so they began moving out of apartments and moving into single family homes. And by the way, one of the themes, something I debated other think tankers and academics a lot over the last 5 years, was this idea that all the millennials were going to live in high-rise buildings, in the creative class urban centers. This thesis was totally wrong. It was wishful thinking on behalf of some urbanists and frankly some environmental policy groups. And it was really being driven by demographics. And they couldn't see the fact that this was going to switch as the millennials got into their late 30s and early 40s. And that's what happened. One thing to note, this is a technical footnote. The last data point we've got for this is the first quarter of 2020. Unfortunately, this data set, beginning with the second quarter and continuing the third, really became unreliable due to the virus crisis. They stopped doing in-person interviews. And this is our source of the homeownership rate data, which you can see on this slide. Now, if you go back to what I said about in terms of the momentum really switching in 2016, you can see it on the homeownership rate as well. It bottoms out there in early 2016 and has actually been rising over the last 4 to 5 years. This was really good news for single family housing because there were folks in our industry, analysts, well-known analysts, who were saying, I think the homeownership rate's going to decline to 61% or 59%. And it didn't. It bottomed out at around 62. And in our last accurate read at the start of 2020, the homeownership rate had been grown back to 65%. The evidence is that over the course of 2020, it has gone up. But if you saw it reported in the news that it increased almost 68%, that was probably wrong. The data set's flawed right now. But we do think that the trend is for growth in homeownership, and then it should begin to level off, kind of a new normal, right under about 67%. But again, this is one of the reasons that demand has grown for home builders. And of course, there's a lot of variation in terms of the geography of homeownership. On this map, there's a county level data. Blue is good in terms of homeownership. Red is bad. Look, your eyes immediately take you to the places where homeownership is a challenge. And it's obviously true in the large metro areas where it's more expensive. The homeownership tends to lag. But it's California, and I don't want to, use California as a punching bag. My dad lives there. I love the state. But it's so expensive to build and develop in California, and the impacts you can see fairly clearly in terms of the homeownership rate lagging, and much of the state being essentially in the red with lower than national averages in terms of the homeownership rate. That's going to be a kind of an important signal in terms of going forward, because we do think the suburban shift is going to increase housing demand in these lower cost, lower density areas. And so places like the Midwest, places like Utah and Idaho and northern Colorado are going to benefit at the expense of places like New York City and San Francisco. And oh, by the way, this is kind of more of a technical footnote, but when we talk about the homeownership rate being 65% or 66%, that's a real-time, right now measure. It doesn't tell you how many people have benefited from homeownership over their lifetime. This is a research project that we did last year. And what we found was about 91% of Americans for some measurable period of their adult lives are homeowners. So when we talk about the benefits of homeownership and supporting homeownership, it really does benefit 9 out of 10 Americans, not 6 out of 10. And this is something that we certainly emphasize with policymakers. A footnote that is holding back housing demand. Yes, we have more young adults living with their parents. Forget the blue line. The blue line is going up 18 to 24-year-olds living with their parents because more of those individuals are going to college. But it's the red line that's been a concern over the last decade or 2 decades. In fact, over the last 20 years, we've gone from 1 in 10 25 to 34-year-olds living with their parents to 1 in 5. That rate has doubled. Now, that rate was slowing down, and we were actually hoping it would start to decline as we entered 2020. Our last data point for this is 2018. But I think, unfortunately, when we look back and get the 2020 data, we're going to see that the virus crisis, unfortunately, pushed that red line even further higher. So this is a policy point, something we need to work on, because the fact that those people are living with their parents, well, they're getting married less, they're having kids less, and they're less likely to enter home ownership, which is an important source of wealth accumulation for typical Americans. All right, so that was the macro and the demand side of the market. Let's take a look at some of the supply side concerns. Yeah, housing really has kind of led the way in terms of those industries that have seen gains. The red is a measure of the broader building material supply part of the economy. And you can see the growth there. Very few sectors in the US economy in 2020 look like that red line. And it's really a sign of the fact that the strength that we've seen in remodeling, in land development, in single family, basically everything in the housing market, but multifamily. The blue line is a little more typical, but even there you see relative strength. Think back to the goods and services and the restaurant and grocery store sales slides I put up, but the blue is furniture and furnishings, electronics, things that go into homes. You can see the very clear V-shaped recovery, pretty good strength. So a lot of downstream strength in terms of things that are connected to housing and furnishing a home. And for builders, the real challenge this year on the supply side has been building material pricing for lumber. And in 2018, lumber prices had increased from about $436 per thousand board feet to about $582. And back at that time, that was a crisis for the industry. Well, you can see what lumber prices did in 2020. In fact, they were up almost 170% from mid-April 2020 to their peak at $955 per thousand board feet in the 3rd week of September. That was the fastest run up in lumber prices that the US has experienced in 70 years. Some of it's due to lumber tariffs, which have just been cut in half. That's good news for construction. And we have seen those lumber prices come down as production has gone up, as more of the mills have come online. We want to see more domestic production of US lumber, because the fact that we saw that rapid run up in pricing did hold back some construction growth, particularly on the remodeling sector, but also single family homes as well. Prices have come down. They're about $594 per thousand board feet, but it's something we're watching in terms of trying to build our forecast for single family construction. And then a factor that's affected manufacturing and construction broadly is the skilled labor shortage. We're sending more people to college, which means we have a smaller labor force for what we call the middle skills industries. And so the red line on this slide is basically an intensity measure of the labor shortage in the construction industry. We could plot a similar number for the manufacturing sector. What you can see in that red line is it's higher than it was in 2006, 2007, which was the building boom. So really over the last decade, we have seen a real tightening of the skilled labor market in the construction industry. In any given month, the industry is short 200,000 to 300,000 workers, and it is a limiting factor in terms of how much home building can take place. And I put this slide up here just as almost like kind of an academic, interesting point, but what you're looking at here is data going back to 1860 in terms of shares of workers in the US economy. And the blue at the bottom, for example, is manufacturing. You can see the manufacturing share declining since the 1960s. We're all familiar with that. The red in the middle is farming. Half of Americans were farmers around the Civil War. Today, it's shrunk. It's gone down to about 1%. Well, the reason I put this up here is that the skilled labor shortage in construction is really unusual. That gray bar in the middle is the construction share, and it's been relatively constant for 170 years. So we think we're going to get out of it, but it is due to some of the changes and things like more kids going to college and fewer people wanting to work with their hands. And that's going to be something that we're going to have to turn around the United States if we want the construction sector to thrive. And by the way, in terms of trying to recruit people in, only 3% of actual construction sector jobs consist of women. So the industry is undertaking a large effort to bring women into the sector. There's been some limited success, but there are resources that are going to be deployed next year that I think will really try to turn the needle on this particular challenge, because we do have elevated unemployment in other parts of the US economy. And labor productivity, this is true in construction and manufacturing, but the red line is construction worker productivity. It's been flat. So we just need to find ways to build more with less. So different technologies, different building materials, ways to find, to save time at the construction work site are going to be key for keeping construction growth going forward. And one of the ways that's been identified for this is offsite construction. It's gotten a lot of attention. This is modular and panelized construction. It's only 3% of home building. And in fact, it was 4% in 2018. So the share has actually gone down. And the reason I put this up here is because there's been a lot of discussion about building homes and factories, typical single family homes. Yes, there's capital in it. Yes, there's a lot of excitement, but we haven't seen the results yet in terms of the underlying construction data. And more importantly, if you look at the data, 20 years ago, offsite construction was actually double the share. It was about 7% of the total construction. So I think the share for offsite is going to go up, but there's been a little bit more hype than hope in terms of offsite construction. All right, so we took a look at the macro demographics, the supply side. Let's put it all together in terms of the forecast. Now, we're going to start off with a data point that I mentioned at the very beginning, which was the idea that single-family sales were outpacing single-family starts by a historic margin. And you can see that on this slide. The red line is single-family home sales, new single-family home sales. The blue is for sale single-family starts. And look at the gap between the red line and the blue line at the very end of this slide. That's the largest gap since the 1960s. So we're selling a lot more homes than we're actually building. And that's the indication that we have growing backlog in terms of single family home building. And it's the reason that builders are so confident because they see so much housing demand that's not being met right now. So I mentioned this at the beginning. This is the HMI, our builder confidence measure. It's at a level of 90. We design it so it provides a short run outlook on single family starts, which is the red line here. You can see these two lines move together. And what it's pointing to is ongoing growth for single family construction. So when we plug that measure of builder confidence into the forecast, here's our forecast. This is single family starts. We think for the year 2020, we're going to be up about 9, maybe even 10%. The data's been coming in a little bit stronger than our most recent forecast. And for 2021, we do have ongoing gains. Now, I will tell you, there's a lot of debate about this. There are some forecasters out there who are saying single family construction is going to be up 9, 10%, and we're entering a golden age of housing. There are other forecasters, particularly in some parts of the lumber industry, who are saying next year is going to be weaker than 2020. I'm kind of in the middle. I lean a little bit more to the growth argument. And in fact, I think in our next revision for our forecast, we could push the 2021 growth rate up as high as 4 or 5% for single family starts, and finally actually get a year where we're building more than 1 million single family homes. But I'm not in the new golden age camp because of the fact that I do think interest rates are going to go up, and we have all those supply side challenges like labor and building material costs that will inevitably slow down some of that production. But nonetheless, for 2021 and 2022, we do have growth, and I think there's more upside risks to this forecast that we should see gains. A common question I get a lot: how many homes should we be building? Well, we think based on demographics and the need to replace older homes, we should be building about 1.1 to 1.2 million single family homes. So you can kind of see the trend line that we've been on since 2010. It's been this kind of gradual growth. I think that trend line will continue into the future until we get to about 1.1 to 1.2 million, and then the industry will level off. So what we saw in 2020 was really a disruption. Again, go back to those grocery stores and restaurant store sales, a decline, a rebound, and then a return to trend. That's our forecast. So ongoing growth, but we don't think that the growth rates that we saw in 2020 will continue into 2021. We're going to have slower growth going forward, more like what we saw from 2015 through 2019. Some trends. This is good news for everyone downstream from home builders. Typical new home size is going up. And it's been going down for the last 4 to 5 years, but we see this in our survey data. We started to see it in the quarterly data. New home size is leveling off, and it's going to increase. And the reason is simple. We're just using our homes for more purposes. And so you have more buyers saying, I need a home office. In some cases, I need 2 home offices, maybe something for the kids to use in terms of studying. So we think home size is going to begin to rise again, which means the economic impact for every single family home is going to go up as we move forward. And I mentioned the fact that lots of people want to get out of apartments into single family homes. That's good for the single family built for rent sector. It's only about 4% of single family starts right now, but I do think this share of homes that are built for someone just to rent them because they can't afford the down payment to buy a home is going to go up. And so we think the market share for this is going to head higher, maybe 6 or 7% over the next 2 years. So that's a growth subsector. And I've mentioned this a lot. These are some maps. There's some debate about this of whether or not we're really seeing the shift in demand from these high density, high cost markets to low density, lower cost markets. And we use something called the Home Building Geography Index, where we group county level data into economic geographies. So for example, what you're looking at on this slide are large metro core counties, and they represent about 17% of single family home building. Now, over the last 4 quarters, going through the end of the third quarter of 2020, these areas were growing somewhere between 5 and 6% in aggregate on average. So some were up, some were down, but in aggregate, they were growing at about 5% rate. If what we're saying about a suburban shift is accurate, what we should see is as we move to lower density geographies, the growth rate should go up. So let's take a step out to a lower density geography, and that's suburban counties outside large metros. This is about 25% of single family home building. And yes, the growth rate over the last 4 quarters, 10.8%. So we're seeing a real shift in terms of growth being higher in these more suburban areas. All right, so let's take another step out and we'll look at small metro core counties. This is actually the largest geography we track in terms of home building. 29% of single family home building occurs in these counties here in this dark red. And over the last 4 quarters, these areas have actually been up 12%. So faster still. And in fact, if we take one more step out to these counties marked on this next map here in orange, these are the outer suburbs, exurbs, you can kind of think of them, of small metros. Only about 9% of single family home building, but they were growing at a 15% growth rate. So you can see a clear connection, a clear correlation. The lower the density, the faster the growth rates. And this is new, by the way. When we look at the historical data, we don't see this kind of disconnect. So this has emerged over the course of 2020, and it's a sign that we're seeing demand for housing, multifamily in particular, going down in places like New York and San Francisco, and going up in these kind of more small metro, lower density areas. And this is good for home building, because when you have housing demand move to these lower density markets, home building is responsible for more of the supply. So that's the reason for the strength in demand. And it's also in second home areas. So that the counties marked in green on this map are counties with at least 15% of their housing stock being second homes. So we're not necessarily measuring direct second homes, but communities that have a lot of vacation homes. They represent about 10% of single family construction on this map. And look at the growth rate here, the year-over-year growth rate in the third quarter. These areas were up 23%. So in some cases, you actually have boomers, maybe some older Gen Xers actually buying a second home. And this, again, is good for home building because, typically home building is driven by demographics. The exception is when people start to buy more second homes. That's where we can grow the market beyond where the demographics take us. And oh, by the way, it's not just single family construction, it's multifamily as well. So all the counties that are marked essentially not in white on this map, the light blue are the exurbs of large metros, the brown and the orange are those small metros we just walked through, and the yellow and the red are rural markets and small towns. So everything not in white represents about a third of apartment construction, and those areas are all growing faster right now than the areas in white. So what we expect in terms of apartment construction is fewer high-rise buildings and more low-rise, 3-story type garden-style apartments. So we're seeing a shift in the rental market, in the multifamily market, from the steel and concrete construction to buildings that are a little closer to typical single-family construction in these outlying areas. And in terms of the multifamily market, we do a quarterly sentiment indicator that kind of gives us a forecast look in terms of multifamily building. It's at a level of 48 right now. That is negative. It's below a level of 50, but it's better than the 27 level that we saw at the start of the year. But when we kind of plug that into our forecast model, here's what we get in terms of multifamily. 2020 is going to be a slightly down year, and we think 2021 is going to be down even more. And in fact, if we look at the current permit data, multifamily permits right now are down about 11% thus far for 2020. So we're expecting 2021 to be soft for multifamily, but then begin to stabilize in 2022 as we get ongoing improvement in the labor market and more parts of the US economy reopen. We should see some stabilization in terms of the multifamily market. And as I mentioned, in terms of the geography, we are going to see a shift in the kinds of buildings being built. The blue columns here, this is total multifamily production. The blue is 50 plus unit, mostly high-rise type multifamily. We think those blue columns are going to shrink going forward just a little bit, and the red and the green, the purple are going to grow. The missing middle is going to expand because of the fact that people's preferences in terms of not wanting to be in a building with an elevator, for example, wanting a multifamily apartment with a door to the outside, that is going to improve going forward because of the geography factor. And then lastly, remodeling. Remodeling's had an exceptional year in 2020. We think those gains will continue, although at a slower rate going into 2021 and 2022. So the remodeling market should continue. People are making additions to their homes, again, using their homes for more purposes. So the repair market is stronger. And we're going to have buyers buying older properties that need to be fixed up and age in place. All those factors should help the overall remodeling market. So just to kind of wrap it all up, when we think about the 2020 rebound for housing, it's been really remarkable. The blue line is a residential fixed investment. It's a measure of overall housing construction spending. You can see the clear V-shaped drop it took. In fact, we're kind of back to where we were in terms of the overall size of the housing and construction market. It's being held back a little bit by apartment weakness, but single family and remodeling are larger. And so the recovery took less than a year for the housing industry. It was really kind of more months. In contrast, the red line is non-residential construction. And in our forecast model, getting back to where non-residential construction was at the start of 2020, we think it's probably going to take 4 to 5 years. And by the way, that's not just our forecast. Ken Simonson, the chief economist at AGC that follows non-residential construction closer than I do, he's got kind of a similar forecast. So this is a flip of 2008, 2009, where the economic pain was really concentrated in housing. Now housing is the bright spot. It really is leading the economy, and we're seeing these downstream benefits to those parts of the economy that are really connected to home building and housing demand. And with that, I want to thank everyone for attending today and PPI for hosting. I'm happy to take any questions. My Twitter account is there on the slide at Dietz Econ if you're into social media. And then ionhousing.org is our economics blog. You can subscribe to that by email. Almost all the data that we went through today is published in monthly or quarterly updates on ionhousing.org. And Lance and everyone else, I'll turn it back over to you. I'm happy to take any questions.
Yeah, thank you so much, Dr. Dietz. That was a wealth of information. As you know,
That's a lot.
Years and years to gather it and put it all together. So it takes a long time to digest so much information here, I think. Just to let everybody know, and then we'll get into the Q&A. So if you do have a question, please try to type it up in the chat box. I have one question come in so far, and I'll address that in just 1 second. So submitting via chat would be the best way, and then we'll read those questions aloud and ask Dr. Dietz to help answer those. And yes, the slides are going to be available to all our members after the presentation. The PDF version of the slides is going to be posted to PPI member login. So if you're a PPI member and you have an account, you can get access to it. And the recording of the presentation, because the narration part is very important, the recording link to that will also be posted in member login within 1 or 2 days. So you'll be able to watch it again. So with that, the first one we have in says, with the backlog of sold but not yet started houses being so large and getting larger, combined with supply chain disruptions in lumber, aluminum, and other building products slowing construction, and the fact that we're now in the slower building winter months, shouldn't that boost 2021 single-family starts as they need to catch up with the backlog?
It will, and that's why we do have a positive growth rate for 2021, even though we think interest rates are going to be higher. I think the question is the degree of scale. There are some who believe we will see a 10% growth rate in single family in 2021 because of that backlog. I think the combination of the supply side constraints, the fact that that we have a skilled labor shortage, that builders were burned somewhat by lumber. That's a bad analogy. Burned by lumber prices in 2020. That they're going to slow up some of the sales contracts that they take. So we're expecting a pretty significant slowdown. It'll still be higher, but a slowdown in actual new home sales contracts. And then we think that will hold back single family construction. So when you put all that together, there's kind of some upside potential, some downside factors that are holding things down. And that's the reason we've got a single digit growth rate for single family construction in 2021, rather than say a 10%, or I've seen even a 12% growth rate for single family home building next year. We're deliberately more conservative. I think in part that reflects the fact that every day I hear from builders in terms of their ongoing challenges, getting the appliances delivered, getting the work crews, running out of lots. They're just, all the different things that all of them have to go right. And there are, just like there were in 2015 and 2016, these limiting factors, which kind of holds single family home building to that long-term growth trend line that we've been on since roughly 2011.
Right, they just can't turn a knob on a machine and start making it making more houses that much more quickly.
Exactly.
Okay, great answer, thank you. Several questions here. I'll follow them in order. The next one
Yep.
is, do you foresee non-residential to residential remodeling shift?
Now that's interesting. So yes, one of the things that we think is really going to benefit remodeling is the fact that people are using their homes for more purposes. We've got some questions in the field right now with designers of, is the open concept floor plan dead? The early answers are no. Home and garden television, if nothing else, will keep open concept going. But there are people looking at more ways to confine noise. From people working at home, studying home. Now, as I said, some of those effects are temporary. So, there are some factors that are holding up remodeling, but I think non-residential remodeling is actually really interesting. And it's something that we haven't done a lot of formal analysis of right now, but I think there's an argument to be made that within office buildings, we are going to see some kinds of structural changes. And so that could actually boost non-residential remodeling. I think where the weakness is going to be is non-residential new construction. And as I said near the end of the presentation, I think that will continue for a while.
Thank you. Yeah, and the follow-up part of that question was, for example, office space converted to homes, which you addressed. I've also heard of shopping centers. We've got these big empty stores and shopping malls now possibly being converted to condos. I mean, if that happens, it's going to use a lot of pipe.
That's exactly right. And I was telling you before, I live in Arlington, Virginia. I live fairly near a almost virtually vacant shopping mall. It's a traditional suburban shopping mall. And yes, that's what we expect to happen to maybe a fifth of shopping malls, which is they will be converted over the next 5 to 10 years into urban villages with townhouses, low-rise multifamily. And yeah, they're going to need the infrastructure to make those kinds of conversions.
Awesome. Next question, are there specific regulations that may come from the new administration that might slow down growth in housing starts?
Yeah, I tried to keep this one a little policy light, but when you get sophisticated viewers, they want to talk policy issues. I'm not concerned necessarily about higher taxes, although that would be a risk. I think the Republicans will probably control the Senate, and divided government's typically pretty good for growth. It's regulatory policy that I'm concerned about. It's things within, like, for example, in the construction industry, independent contractor rules, what are called the joint employer rules that govern the relationship between a general contractor and a subcontractor. And then I'm really concerned about the land development and environmental rules. We saw in 2015 and 2016, as an example, the waters of the U.S. rule, which would have expanded, and this was done at the end of the President Obama's administration, it would have expanded the amount of land that would needed a clean water permit, which can easily add $10,000 per lot. That was put on hold with the Trump administration. Those kinds of rules, depending on who gets appointed to these regulatory agencies, could come back. So it's going to be a big deal if you're looking in terms of land development. Let's watch who is appointed to the Interior Department, who will head up the EPA, and on the labor side, who's going to get the Department of Labor. A Department of Labor headed by Senator Bernie Sanders would look very different than a labor department with maybe someone who has local government experience who wants to help increase infrastructure. So regulatory is the area where I think we've got some concerns. On the more positive side with the election result, we'll probably see a little bit slower change to Fannie and Freddie, and that could help support housing finance. But to me, the big risk from a policy point of view right now is regulatory policy.
Okay, thank you. The last question I see here is about electrification. So the question is, do you see electrification trends expanding and going forward, or will it just be regional? For instance, in California, where we've heard that several cities have banned installation of new natural gas pipelines for future construction. They want everything to be all electric energy sources.
Yeah, I think the political wave is there, so that's certainly something to be gauged on an advocacy issue. We see it, I would say, in terms of energy production. It's you talk to a builder and they'll talk about solar. So California is a good example there, where new homes are going to be required to have solar panels, and whether it's moving away from natural gas and requiring electrification, or whether it's requiring solar panels, what do those kinds of changes do when they're imposed on the market? They increase the cost of housing and they price people out. So we're the priced out effect for every $1,000 that you add to the cost of a newly built home, you price out about 160,000 households from being able to qualify for a mortgage and buy that home. And I think, unfortunately, California is going to continue to learn that lesson. You think back to that homeownership slide I showed, where a lot of those California counties were in red. California is building a lot of homes. The problem is that they're building them in Utah and Idaho and Colorado. And I think that process will continue unless local policymakers in states like California roll back some of these regulatory policies that increase the cost of construction and take away the ability of consumers to make the market choice that works best for them, including items like gas versus electrical when it comes to powering homes.
Excellent, thank you. The last question I see, you may have touched on this. The question is, for existing office space, do you anticipate a conversion to shared space, for example, the WeWork model?
So this question is a great one, and all I can do is speculate here. And we were talking before we got the presentation going about different expectations, or how people relate in the office, or how important being in the office or the factory is, depending on the kind of job you do, even your personality type. I believe that this is going to increase. So I think there will be more kind of bullpen type offices, just in time office space, because businesses are going to look at the amount of money they spend on commercial real estate and say, we probably didn't need it. So we can reduce it down to a core level, and that's going to increase things. I will tell you that when I've said that within NAHB, most of the other senior staff have basically given me a hell no response. So this might be where an economist is saying, hey, that sounds like a good idea, and the real world will say, well, there's a lot of challenges with that. So I think there will be some increase of sort of just-in-time office environments, or people working at home 2 days a week and allowing that decentralization housing demand. But there are a lot of good productivity reasons to get people back in the office. And so again, go back to that grocery store and restaurant analogy. Some of these things will be permanent effects, some will be temporary. The permanent effects will be partial. And so that gets to that question in terms of the future of office. We're going to roll back after a vaccine, but I think there will be some permanent partial effects, growth for some kinds of workers in some kinds of cities.
Excellent, yeah. So many unknowns, so much, so much forecasting, so many glimpses into the future. I think we've come to the end of our time. Great questions, everybody. We had a tremendous turnout today, over 100 attendees. So on behalf of everybody, including our building and construction division, which organized today's event, and all the other PPI members and staff, really want to thank you for your time, Dr. Dietz, in preparing and delivering this presentation to us today. And as Kate Olinger mentioned at the beginning, we really look forward to working more closely with you in the future.
Absolutely. Yeah, thank you, Lance, and thank you, Kate.
Yeah, all right. Thank you so much, everybody. Appreciate your attendance today.
Thank you.
Thank you. Bye-bye.